Welcome, welcome to everyone from around the world, wherever you are joining from. I'm your host, Lisa Wardlaw. I'll be moderating this esteemed panel today on catastrophe-proofing insurance, leveraging data and analytics for sustainable growth. Joining us today, I'll start with Kirsten Bissett, VP, Chief Actuary, Data and Analytics Officer, QBE, North America. We have Eric Olson, SVP, Property Center of Excellence, Leader Risk Engineering Services for Chubb. Jimmy Gallagher, VP of Capacity and Risk Markets for Coterie Insurance. And Darren Govender, VP North America Market Lead, Analytics, Swiss Re Reinsurance Solutions. And let's go into just a little bit about why are we talking about catastrophe-proofing insurance. Many of you who are joining probably are joining because we're all dealing with similar scenarios: increased frequency, increased severity, staggering losses in the industry and society at large, for the uninsured, as well as the insurance coverage, which is what we're trying to solve. How do we continue to create affordable, economic driven coverage and additional options? A little bit of facts, as sponsored by both Reuters Insurance and Swiss Re. According to the Swiss Re Institute, 2022 was the second consecutive year in which insured losses from NatCat, we're excluding extreme weather events here, we'll talk about that as well, exceeded 100 billion. 2023 did not prove to be a better year for the industry or, again, what we experience as society in large. In the absence of reliable and accurate insurance exposure data, it becomes increasingly difficult to offer the level of coverage that's needed to provide certainty and coverage for those people looking to ensure that they have coverage in their greatest time of need. Joining us today, we'll be going through data-driven underwriting excellence, innovative risk mitigation, from react to prepare, prevent, and growth amidst catastrophe. So with that in mind, I would love to turn it over to our panelists to give you all some insights and reflection. And before I do that, just a quick reminder that at the end of our discussion today, probably the last 10 to 15 minutes, we will be answering your audience Q&A directly. So please make sure you use the chat function to ask questions, and I'll be organizing the questions to tee them up to our panelists. Kristen, I would love to start with you as a reflection on, in your role as chief actuary, because clearly the numbers matter, how do you think through using data and analytics for underwriting excellence and continuing to catastrophe-proof insurance? Over to you.
Well, I think, as you mentioned, Lisa, we're at a point where we really have a crisis, particularly in some areas with availability and affordability of insurance. And it's not just a financial issue, it's a life safety issue. In some cases, if you look at the loss of life we've had in recent major events. And so I think it's really important that we as an industry can better help to mitigate the losses, but also to find solutions for these people who need our protection. And a lot of that will come true through the use of data and analytics. We can't expose our companies to failing if we don't understand the changing dynamics of weather events, and we don't understand our exposure. So what that means is we end up taking less risk because we don't understand how to price for it or what we are covering. And so the more we can provide those higher analytics to actually understand that, the more coverage we can provide, and the better we can work with other partners, maybe even publicly, to help do some of that mitigation and solve these problems.
Yeah, I love that reflection. And I think it's so interesting because a lot of times we as an industry will receive a lot of public criticism for exiting markets or, hardening rates and all these things. But to your point, Kristen, it's also like, how do we ensure that it's that we're actually not only solving the problem, but that we're solving it in a way that's also like we have to have capital.
It has to be sustainable, right? It has to be sustainable. We have to be able to actually be there for our policyholders in the event of that emergency and actually provide that support, right? And so the more risk there is in that number, sort of the more conservative we have to be around what we can provide, because we need to really understand our commitments to our policyholders, right? And so the better you understand that, the more you can provide. And I think that's a key role that advanced analytics and new technology can really help us solve some of those problems for people so that we can actually expand coverage and be there for more people.
Yeah, I love that. And so Darren, I'd love to hear your reflection. I spent a little bit of time working with some of the solutions at Swiss Re and some of the product offerings, and some of the things that you all are trying to do. I'd love to hear your reflection as you think from this from a reinsurer lens on what are the types of solutions you're trying to offer both society. And I know a lot of government partnerships, and I also know a lot of technology solutions that you all are trying to think through in terms of also supporting the carriers. So over to you, Darren, for your reflection.
Yeah, of course. Thanks, Lisa. I hope you had a good experience with our products. Of
course.
I kept rereading this topic, just the heading, right? Because oftentimes we put out these topic headings and it's like, okay, what are we trying to say here? And I oftentimes got stuck at catastrophe-proofing insurance because it sounds oxymoronic in a way. So I think the first step is, and Kristen kind of touched on this, is to accept that we're never going to fully catastrophe-proof insurance, right? But what we're trying to do is to get things back within ranges of control and predictability. So I think just having that at the outset gives you a little bit of peace of mind going into it, because you're never going to fully have a grasp on it. We exist, to Kristen's point, to protect people against volatility and to be there in times of great need. So that's my initial framing. And then, as a solutions provider, from a Swiss Re perspective, we have to get quite concrete about what we can actually do about this. So again, reading the heading, catastrophe-proofing insurance, leveraging data and analytics for sustainable growth. Well, what are the levers that we have? So we can manage portfolios holistically and groups of policies, or we can manage policies one at a time at renewal or at new business when they come in. So those are the two levers we have. Well, then how do you grow? So you have to write more or quote more, and you have to renew more than you do on average. So, okay, cool. So we know how to grow and we know the levers we have. But then the problem is, how do you do that sustainably? Well, now you've got to understand how each risk contributes to your portfolio when it comes in. And so you have to understand the impact on the portfolio. And if the risk coming in is profitable, and you've got to write profitable risks and renew profitable risks. So that's how we can sustainably grow. But then where does data and analytics fit into this? So we have to accept that data and analytics is not some silver bullet. We've been talking about this for years now, about how it's going to solve everything. And I think it requires us to be quite intentional about what are the levers that we have and how can we be more predictive in those levers. So when a new policy comes in, how can we ensure that it is accretive to our portfolio, that it's priced adequately so that we can provide coverage for portfolios as a whole. And so, yeah, I think it's not a solution, but when we're thinking about this and when we're creating solutions, that's what we're trying to do, trying to get to those levers that people can actually control, which is at point of sale, at renewal, or in shaping a portfolio. So I'll leave the monologue there for now.
Yeah, no, we've got some good questions coming up to deep dive that. Can't wait to get into that. Eric, how do you think of this as, like, at large scale, kind of bludgeoning losses for our industry, yet connecting the need to be there for our customers when they need us most, right? Like, how do you think of that in your role at Chubb?
Yeah, I think Darren framed it out really nicely, which is the law of large numbers becomes much less effective as risk pools become more concentrated to cat exposure, right? That's when our industry is in peril. And so you're acting as a catalyst in our industry. You need to act as a catalyst in our industry from the location level all the way up to the schedule and the SOB and the portfolio level. And I'm on the front lines within a risk engineering leadership role. I am tasked with turning data and analytics that we provide to our customer, that only several years ago we would never provide this level of modeled output directly to a customer. And I'm tasked with making it meaningful and actionable at the location level and across a portfolio level. And that's a very daunting reality when you're talking to a CFO or a CRO or a CSO. So as our industry is grappling with how to be an effective catalyst to affect resilience and to affect physical risk mitigations, adaptations, whether that's at a location level, portfolio level, or better yet, a community level. All right. It really becomes 360. It's challenging, but it starts with education, and it starts with risk appreciation, helping policyholders understand that risk. So both Kristen and Darren really, mentioned that reality of education, understanding the risk, and really helping provide recommendations to our policyholders. And that's well beyond just the location level, right? That's in certain geographies that we know are prone to exacerbated or amplified natural hazards reality, especially over the past, at least decade, as we watch the reality of climate change unfold and how it amplifies, how it intensifies existing natural hazards, right? So, it's a balance between understanding models, understanding the limitations of models, understanding, the strengths and weaknesses, looking at many models, and really balancing that with on-the-ground risk engineering. So there's a real balance that we take with our policyholders and how we educate, how we communicate, how we expect or assist them in addressing resilience recommendations that are CapEx. They're big. These are big dollar items. If you're talking at a location all the way up to a community level, and you're looking to make this data actionable, it's not going to do it on its own, right? As a catalyst, our industry needs to educate, but then needs to work with policyholders.
I think about that, my you're cheating a little bit. I'm cheating a little bit because my word of the year for 2024 is applied, because all of this has to be taken and made actionable. And Jimmy, I'd love to pivot over to you for your insights on this as well. And then I cannot wait to kind of get into the dialogue and discussion between the four of you. Over to you, Jimmy.
Yeah, so I think I sit in a kind of an interesting spot of this panel where I'm dealing with both the reinsurance markets, the capacity markets, but I'm also, in-house as a carrier, small commercial carrier, applying this, to the market and doing a lot of what Eric is saying. How do we take this data and make it actionable, so that, we can continue to add value long-term to our policyholders, and all the other stakeholders. I think what makes Coterie a bit unique in this space is that we do 100% digital underwriting, which means that the data has to be there. And the nice thing about weather is that there's a ton of weather data out there. There's a ton of weather vendors out there. I spend a lot of time chatting with those folks. And I think what a lot of people don't really realize here in the United States is all our weather data is free. You just have to go get it and be able to work through it. And so when we are strategizing about what to write, how to write it, we are looking at it in multiple ways. We're not just looking at a single cat model. We're not just looking at a single data point from a single vendor. Coterie really goes after the redundancy of data, and then we're using all of that data, not just in how we write the policies, but where we write. So the sales, the producers, so how do we want to diversify risk? So it's for me, it's really, weather is kind of one of these silly side passions that I get to apply to my job. So.
Thank you. And I was just thinking I spent a lot of time on with very similar, like not with you specifically, Jimmy, but I spent a lot of time in kind of the, how do we apply data to NatCat? And so, and to your point, there was this initial, and I'd love to hear your thoughts on this, you all, because I want to ask you, like, how do we actually use cases to apply data and analytics to actually combat the increasing nat cat losses. And so like I have a theory on this, but I definitely agree with you, Jimmy, in that when we started this, we kind of thought it was like pick the best, pick one source, pick one, modeling tool, like, et cetera. And Darren, that's when I started working a lot with your team, and Kristen, I was working with your team a lot on this as well. But you have to have multi models, and then it gets into data consistency and data validity, because of course some of the data it starts to contradict itself, right? Like, so I'd love to know how you all think about like on one hand, there's the availability of data and the availability and accessibility models. On the other hand, there's this concept of going from static, like point in time, to dynamic, meaning things are changing every minute of time, especially in that cat. And then the third layer to this is there's a lot of data out there, but not all data is the same. Not all data has the same lineage. Heck, not all data even has the same level of accurate geocoding assigned to it. So I'm going to kick it over to the four of you for how do you all think about these spheres, if you will, that you have to like align? And Eric, I see you beaming the most. I'm going to kick it to you to open us up on this question for how do we actually take all this world of data and analytics, and then our job, to your point, is to apply it, right? Like, how do we get to the point where we can actually apply it? So over to you first, Eric, and then love to hear the remainder of you three like commenting on this, because I think this is it's a complex puzzle to solve.
Well, I'm smiling because that's exactly, how we're challenged when we're trying to make data and analytics actionable with mitigations or adaptations, which cost a lot of money most of the time. When you're talking about a new building or the life expectancy of a construction project in a flood-prone area, let's just say anything in Florida, or in California with wildfire, and you're looking at helping a client understand models. Climate change models, and climate change is still largely stochastic, and it's still largely this climate change modeling is nascent. All right, Nat Cat modeling has been around for a decent while, and it's probabilistic, and we base it on historical patterns, and it's helpful. But as you project further and further into the future with any Nat Cat model or climate change model, it simply becomes more uncertain. And that's a reality. And our clients are very educated and expect that a modeled output is one piece of the conversation. It's one piece of the risk management decision and framework. There's a reason why scenario analysis in our space, as we work with clients to conduct scenario analyses on a longer term risk management framework to understand their risk across a portfolio. There's a reason it has to be an art and a science. It has to be qualitative and quantitative where you can make it, because you are essentially performing a cost benefit analysis for a client based on a variety of data points, whether it's your best Nat Cat, high resolution, models for flood, or your non-modeled risks and realities around severe convective storm, right? So everyone needs to accept that you do the best with the tools that you have. And as the econometrics are making their way into these modeling solutions, then the methodologies become questioned, right? Whether you're talking, whatever metric, whatever physical risk metric you guys want to talk about, whether it's a PML or an AAL or any economic loss estimate, they're all questionable, right? And they will be questioned. And when you perform scenario analyses, right, there's a balance between on-the-ground engineering and on-the-ground truth and data outputs. And there's a big gap between that, in my experience. And our job in our sector is really to help clients see the truth between that gap and to make decisions with both the art and the science of this conversation. If you say to any client, you can quantitatively prove to them the ROI on a climate change resilience CapEx spend of $10 million on a building envelope, you would be lying to them. So certain perils, it's easier because our modeling is better, like flood, but many of the perils, including non-modeled, the conversation is very much a business decision. And it's absolutely a qualified business continuity, business impact decision.
All right, so I'm waiting to see who's going to jump in next.
I think I would just maybe pick up on a little bit of what Eric said about scenario work. I think understanding your realistic disaster scenarios is really important to understanding your risk profile and making things more concrete for people, like he was saying, right? So, yeah. Depending on who your audience is, talking about PMLs may or may not resonate, right? But if you can talk about something more specifically in the context of if Hurricane Andrew happened again, this is what you would experience, right? That can make things more real. I think from a broader portfolio perspective, in terms of the use of data and analytics, completely agree with what Jimmy said. The more data we can get, the better. And our ability to process that and then turn that into a usable tool from either a pricing standpoint or an underwriting standpoint is really key. Whether it's underwriting through a box or underwriting with people, you have to have something that at the end of the day is useful to the way you go to market with your customers, and that will actually kind of create results that make sense. So you can, to help you build that portfolio in a way that both supports your growth goals, your profit goals, but also protects your capital, right? And so understanding how much capital you are kind of applying to that portfolio to support it, and the risk around that portfolio really comes out of a lot of that use of data and those modeling techniques to understand those scenarios and actually understand what drives your risk and can help you build out your overall pricing and underwriting appetite.
I'm curious to know, maybe Darren and Jimmy kind of weighing in on this and then connecting what Eric and Kirsten were saying is, I think we also need to change the way we think about underwriting, meaning like we've always done underwriting at this kind of maybe at the actual location level and then at a portfolio level, but we haven't done it as dynamic. Like what a lot of what Kirsten was saying is like, how do you bring this data in to, I call it like buying your offsets as you're underwriting your good with your offsets, and kind of how do you all think about that? And I was thinking like, since you sit at the intersection of the reinsurance market and the insurance, Jimmy, and then Darren, of course, at the reinsurance side with some of the tools that you're trying to enable at Swiss Re, I'd love to hear your lens on that overall question on use cases, right? And then if there's anything specific for how you're trying to bring that data in, maybe more real time, or are you like, what are the actual solutions that you're saying? How do we increase our appetite for risk while making sure we're protecting our capital, which is, the fundamentals, which is what Kristen was saying. Maybe Jimmy, you first.
Yeah. So my approach to it is I work hard to understand what can our company bear. And I don't push that line up. If we can only write 5 million in high cap prone area, then that's what we're going to write. We have to decide where are we going to write that, because we have to protect ourselves, protect our capital, protect our reinsurance and carrier partners, being an MGA. So, and we're very, we approach it in a very transparent way. The other thing that is, I probably drive my insurance team a little crazy on it, is that I'm never content with what we're doing. We need to keep reevaluating. The weather is doing crazy things right now. If you were to look at weather trends and how they've shifted over the last, 5 to 20 years, there's a lot of weird things going on. Tornado alley is shifting. Hurricanes are, they're more predictable than ever, but how they're hitting the states is different. They seem to be slowing down and causing more of a rain event. So I think it's really just getting into the depths of really understanding these events and saying, can your company bear it? And at a certain point, you just have to say no. The other thing that I say a lot internally is we're going to have large events every single year. What we don't know is what that event is going to be. So when the wildfire hits and causes the damage that wildfires can, we have to be able to say, okay, well, we've diversified this risk in the middle of the country or in East Coast. And again, I've seen it over and over again across many companies where it's easy growing in cat prone areas, but there's a reason why it's easy growing. So you have to be diligent and you have to control that low hanging, just going after that low hanging fruit.
For sure. All right, Darren, let's put it all together.
Let's see if I can build off all of this. There's so much good that has been said. I think what I can bring here is I like to think about all of what was said in terms of a framework, right? So I think we're all saying there's certain things we can influence. So what are these things? And maybe the folks on the panel here can correct me if I'm wrong, but I think that there's probably really three areas that the data and the analytics that we're talking about can come into play. The first is at a portfolio level, right? You can't really underwrite at a portfolio level. You have the portfolio and you can set a target portfolio. So usually it all starts there. This is the diversification you want. This is the structure you want. This is the exposure you want. And so you set that at a portfolio level and you use stochastic modeling to understand that the possible exposure at those levels. And that's where the law of large numbers and everything works out and it's beautiful. But then you've got to come down to reality, which is pricing and underwriting at an individual location level. And so one option you have and the second lever effectively is to price. And so we can introduce new variables in pricing. So that's your second use case. Your third use case is to introduce these new variables in underwriting. So you can underwrite away at renewal or at new business what's coming in based on what you can predict about the future. Now, these two things, and Lisa, you were getting at this, is that they're disconnected, right? So they're not dynamic in any real way.
Right.
So one of the new innovations that we've seen, and we're working on this with some of our products, is how can when a new risk comes in, can I know if that risk is accretive to my portfolio as a whole in real time? Can I link it to that portfolio? And so we're working on some products that will allow you to understand each new risk as it comes in the context of your portfolio and not independently or in isolation. It's a lot of work and it's very complex and the covariance matrices are out of control, but this can be done. And so that's something new that we're thinking about. And then at the back of my mind, I always think, well, my initial background was in life and health, where you underwrite a risk and you have to live with it for 40 to 50 years. So in P&C, we can't really complain. We have every year to re-underwrite. But yeah, so I think the three areas that I spoke about, portfolio, underwriting, and rating, those are our boxes that we can influence. And what we need to connect is the rating and the underwriting to the portfolio in real time.
Yeah. So let's and I love that, by the way. And I think that what we're seeing, and it's connecting to what you're all saying, got the data and analytics, we've got new information emerging that we have to have this responsibility of, like, how do we actually draw truth in that information and apply it? Like Eric will just keep beating that drum. Like, how do we make that tangible and real? So, from the perspective of your lenses, what I would love to know is, what new strategies are you all thinking about applying? Maybe Kristen, we'll start with you, to effectively create innovative risk mitigation that allows you to stay in markets, that allows you to support a relatively, underserved or, a population that may be without, how are you innovating along this spectrum? And, clearly, like, I know QBE is global, right? But we're seeing a lot of exiting markets in the US, which is, on one hand, we understand it economically. On the other hand, it's causing a societal, purposeful problem. So what, and I know we're all working hard, right? Like we, and it's not like we just woke up today and started thinking about this. We've been working on this for decades, right? So Kristen, over to you for how you're thinking about innovative strategies, and are there any challenges with those strategies that you would offer up to the people listening in today that you're trying to overcome, and maybe how?
Yeah, going back to your comment on decades, the insurance industry has funded the IBHS to research, business and home safety and weather events for years, right? And they've done great work in terms of improving building safety, building materials, building codes, all of those things, and in a very real way. So that's been going on for decades, and I'm sure will continue. But I think in terms of things that we're doing, a lot of it goes back to some of the things that really Eric was saying, like how can you use better information to get more mitigation from your customers? How can you support their investment in their own properties? So for example, how can you use video and do analytics on videos to say, hey, your property would be better able to sustain an extreme weather event if you did things because you have a lot of brush around it and you're in a fire zone, or you have whatever it is that you have this roofing material is wrong. And that's very hard to do or very expensive to do without some of the new technologies that allows you to do it in a much larger scale and allows you to use newer analytics techniques to actually drive some of those mitigation. You can use that both in underwriting, but also maybe equally or more important in the actual loss control mitigation activities, right? So I think there's a lot of companies out there, a lot of new technology out there, a lot of new ways to apply analytics to those new techniques that can actually help you a lot. The secret, I think, as Darren said, is how do you then take that back and loop it into the underwriting, pricing, claims, portfolio management loop and get all of that to work seamlessly together. And I think that's pieces that everyone's trying to explore as they look at these new ways to gather information and to share information, is how do we leverage it across the spectrum of the things that we do.
Yeah, and I'm gonna jump down to you on this one, Jimmy, and then I'll jump back up. The way my screen is shifted. What innovation strategies are you deploying? Are they along those lines? Are you doing anything like in addition to or otherwise? I think we're probably all we're all chasing the same kind of holy grail, if you will. Like, how do we put this all together?
Yeah, I think we do some very similar things. We talked about, controlling where we write and how we write and the price of the risks. We really focus on insured education. The more you can push out to an insured and educate them on, hey, hurricane season's here. These are the items that you should have on hand to be prepared. That's really a big part of the approach that we've been taking, and we share that not just with property purchasers, with everybody. The other thing, and I mean this in the most loving way to our states, all 50 states here, but what can we do? Litigation environments have gotten tough. A lot of the pulling out of some markets have been due to some struggles that companies have had with the departments of insurance. And I think the more that the insurance industry and the departments of insurance can really partner together and work together, and I think we all have the same goal, to offer valuable products to insureds, and really just work together on how can we just solve this, because in my opinion, the insurance industry alone is not going to solve it. So we need to work together across, lobbyists and all of us, the whole piece, and see some movement there.
Really getting into that public-private partnership. Yeah. And I know there's a lot. There is actually, and I don't know at what levels people see this, depending on like your kind of where you are in the spectrum. But I know there's a lot of public-private partnerships. I know of lots of people, like I'll just use the U.S. as an example. I mean, clearly there's all global, but I know there's a lot of work going on with FEMA and with the Department of Insurance, and how do we use these innovation strategies. One thing that I haven't yet heard anybody mention is like a combination of indemnity and or parametric, like combination products that kind of serve. I know there's a lot of government projects also working on parametric, like quick pay for certain things, like but not in lieu of indemnity insurance, right? Like I'll call it like in addition to, as another form of coverage, especially in areas that might not have coverage. And I don't know, Eric and Darren, what innovative techniques are you all working on? I know there's a lot out there. And maybe Darren, over to you first. Yeah.
So I'll be a couple seconds on this, because I think Kristen and Jimmy have captured the essence of it. The innovations in this area are all the boring things, right? It's the Department of Insurance It's the focusing on the model building, the construction and the parameterization, being hyper focused on the content and the data that you use. And really, I want to really emphasize this point. The parameterization and building of the models is the crux of this. We talk about all of this stuff, right? But it all comes down to, can you build a model that will provide lift? And so honestly, our innovations is focusing on that content and putting that best-in-class content on our platforms for our clients. But it's boring. You know, you sit in front of a computer looking at code and data and trying to make it talk to you. So yeah, that's it for me. Boring innovation here.
Is that part of your struggles that you overcome? I'm joking. We always say that the biggest things that we solve in insurance aren't the shiny balls. It's usually, to your point, the core blocking and tackling, which it always comes back to, like the models, right? Although maybe, Darren, I would amplify that. I think, and Eric was hitting on this as well, it's not just our traditional way of modeling. I think our traditional ways of modeling, while clearly have served us for centuries, decades at a minimum, are not necessarily as elastic as the information that we can take advantage of now. And so I think I used to call it decomposing the nat cat models. That was just like a word I used to use with some brokers. We were working on this, like, how do we decompose the nat cat models? And I think that that's also an innovative strategy. So it is the modeling, but it's also the willingness and vulnerability to tell ourselves that the way we've been modeling may not be the way we need to be modeling always in the future. And I'm not saying, like, and Eric, over to you on that. I'd love to hear your lens on that, because it's hard to admit the way you've been doing something for 100 years may not, it's got a place, but it may not be the only place, which then we think of, how do we loop multiple models together? So Darren, it's that, which I know, I know you all do it Swiss Re too, right?
But Lisa, are you saying that actuaries haven't been modeling correctly? No, I'm just kidding. It's
No, I'm not.
No,
Please don't quote me on that one. Thanks, Darren. I'm gonna have lots of love DMs after this. On that happy note, over to you, Eric.
Yeah, no, listen, I'm laughing because I'm gonna ask Darren to go like this, because all models are wrong, some are useful. That's an old adage, and well beyond just nat cat and climate change modeling. But I think the reality is, we're having there really are two consecutive conversations we're having here, which is number one, right? How does the industry remain profitable and grow through this reality of ever amplified nat cat in intensity, in frequency and severity? And we can debate all day long which perils, but the trends are obvious, and the numbers don't lie. Like Kristen opened it up beautifully with that reality. But I think, how do you innovate beyond? The modeling is not going to solve climate change. The insurance industry is not going to solve climate change, right? It's this huge reality, and it's this huge problem that we play individual roles in catalyzing how to make our insurers insurable for the long term, so we can exist as an industry and our clients can have effective insurance coverage that's affordable for the long term. And you need and you want a private market, because we know how the public insurance programs have performed, or not. And FEMA's the perfect example of insolvency without government bailout for many, many years. Why would we think we're any different? The cover will continue to increase in cost as the result of inflation and the reality of the numbers that you opened up the call with. But how do we cope with it? How do we make those year-on-year terms and conditions more amenable, more survivable for a policyholder when they're looking at their rate increases? The reality is, and everyone has said it multiple times, you have to start with education around risk. Every single one in this industry needs to, make sure, if it's a policyholder conversation or even not a policyholder, prospective clients. As we engage, Chubb has become extremely vocal about sharing more data and providing climate change data and scoring at a very simplistic level. Last year, we went out to every publicly traded, about 3,600 publicly traded companies in North America, and we offered them free climate change data, free data. And in a report card format, let's just show you with yellow, red, and green, very intuitively, where we see your runway through 2030s, 2050s, along 8 perils. And why did we do this? Well, we did this because we're trying to show the market and our policyholders that the increasing regulatory pressure is the reality of that, whether it's SEC or it's California SB, Senate bills over the past couple months. You have to start somewhere, right? You have to start somewhere. And where do you start? Is it at the portfolio level? Is it at a sample of locations in the portfolio? The conversation starts with most clients where they understand they have the most risk and the most value exposed, right? It's a correlation between risk and value and business impact. I say resilience to every client. Resilience is business continuity planning on steroids. That's what it is. And if you practice business continuity planning, right, then resilience takes it to the next level. And I think education beyond just physical risk, right? Chubb has also been really vocal about certain types of greenhouse gas emissions to certain policyholders, especially around methane. We've been very vocal around our methane resource hub, where we are educating clients on, some low-hanging fruit, I'll say, around certain greenhouse gases, where really frameworks and planning frameworks that are very achievable to make very effective reductions in certain classes of business are really, really important to us. So it's not only education, but it's making actionable frameworks that we believe are very impactful to certain classes of business. So it's property, it's the physical risk, but it's also the transitional risk component, right? It takes both. It takes physical risk and transitional risk, and it takes education, but it does take showing them data and showing them modeled data as well. It's absolutely part of the conversation, but it is certainly not the entire conversation.
Yeah, and let's take a couple of the audience questions to the panelists, and then I kind of want to kind of loop back through the profitability and driving growth at towards as we wind up. But first question coming in specifically on the CAT model. How do you recommend blending the CAT model results into rate plans? This would include concentration and not just AAL. And I don't know who wants to take that one, but would love to hear.
So I'll start maybe, and folks can chime in. I think, if you think about AAL, which is just obviously your average loss cost that comes in, that would normally be the starting point for your rating plan, right? Where I think you start to think about concentration is where you think about all the possible things that could happen around your CAT curve, right? You have things that are just profit events, you make less money, and then you have things where you have capital events, meaning you lose money and you start to eat away at your capital, right? And a lot of those things will come from concentration events. So one way to think about how to incorporate that in your rates is to say, how much capital do I have to hold to actually support this book? And therefore, what's my profit load that I need to build into my rates, given that capital and given the expected performance of the book on an expected basis, right? And I think that understanding of those scenarios and kind of the shape of that whole curve and how your portfolio actually lines up with that, how much are profit events versus capital events, et cetera, can help you build appropriate rates around that. It's also, I think some people have talked about just what's your tolerance for risk, right? And that can really drive that. If you have a very low tolerance around, losing money and having those capital events, that can also shape the way you think about your pricing and those concentration things.
Yeah. Anybody else want to weigh in on that one? Anything else to add?
One other thing.
I think Kristen brings up a fantastic point. As we turn data into vernacular in client conversations, the majority of insurance buyers don't understand, what a 100-year event is or a 500-year event and how that's shifting. And the majority of the industry does not do a great job disclosing really their basis for Nat Cat loss estimation and how they view the reality of both modeled and non-modeled events, whether we're talking PMLs, return periods, or the uncertainty of longer term AALs, PMLs beyond a year-on-year projection, right? A near term. We're really great about talking things on a very near-term basis in insurance space, right? But we're not going to make really good headway until we start talking to policyholders and ourselves beyond our extremely myopic near-term Nat Cat view. So, we do need to start, I think, as an industry, walking our talk much better in terms of what we're disclosing on our 10Ks, the certainties and uncertainties that are realities with near-term and long-term modeling and loss estimation and AALs and PMLs. And if we expect our clients, if we expect to be a catalyst and expect our clients to invest CapEx to make themselves more resilient, we have to foster the community level conversation. It's got to be beyond the location level. And how do you do that? Well, we have the data, our industry. We know what our concentrations are. So what are we doing with it? Beyond being profitable, beyond charging 30 to 60% increases on flood, right? Which is unsustainable for the buyer, right? What are we doing as an industry to spur community level resilience so the long-term exposure is mitigated, is adapted? And that's the challenge. It's the real challenge.
So coming right in on that I want to see if anybody wants to weigh in on, and I'd love to take this one live, because you just talked about concentration. Can concentration be part of the plan? And then kind of extending beyond local concentration, which we would surmise as portfolio level risk. But I think portfolio and offsetting risk categories is something that we're all looking at. Again, that dynamic, Darren, like weaving that in to kind of like at point of underwriting, not like reflective, like, are we going to place reinsurance here, there, or et cetera, but more like dynamically when we're underwriting to be able to see, I call it the pluses and minuses, and kind of having that portfolio level view. I'd love to know maybe what you think about that. And then specifically on the concentration being part of the rate plan.
Yeah, no, I think I honestly think Kristen answered it. I think the way she summarized it was great. That's exactly the way to think about it. So I won't add to the rating, but to the second question, Lisa, and to what you were getting at. So we've seen a number of clients, maybe 3 years, 4 or 5 years ago, no one was talking about this, but we've had 5 or 6 clients on the solution side come to us and ask us about how to do this, how to link each new policy to the portfolio. And it calls for a more complex solution, right? Because you can't just create a simple API, sell that API per ping, and and you go with it. You've got to now create a link on somewhere on the back end of that API service to the portfolio, so that the service understands if a risk coming in is accretive at a local level or at a global level. You can create these constraints on the portfolio. And so I think this is a new innovation that's coming in. We are working on it with a number of clients, but yeah, I would encourage, the more people thinking about this, the better. Effectively, for each new risk policy or SOV coming in, how does it impact your portfolio? And thinking about that in real time and having systems that do that, that's a big focus for us right now. It's taking up a lot of our time. And I think it goes exactly at this concern that you've had, Lisa, for a number of years.
Yeah, we started calling it risk streaming, and how we put all this together to give this elasticity of risk awareness. And Kristen, to the point you were mentioning, which is your capital and your risk tolerance, because if that's static, while your risk is actually coming in at a dynamic level, there by definition is a disjoin there that intuitively you would think is simple to solve for, but it's actually harder to solve for, Darren, as you pointed out. I'm going to go back to the open questions and just say, maybe that I think we intuitively think of global warming as we think of climate change. And I think Eric and the panelists were tackling this as well, but I don't know if there's anything to add there. And Jimmy, I wanted to know if you had anything on the, how we think of the modeling. I didn't want to not let you weigh in on that.
Yeah, so exactly what Darren said is exactly the path that we're going down. So we're looking at, what can we write? Where can we write it at both a geographic, macro, and micro level? I would probably add one additional level to that, where our desire is to have that production model be intelligent enough to say, okay, well, you just wrote, let's say, five risks that have an estimated value inland, let's say northern Georgia. I'm in Georgia, so I'm going to pick on Georgia. But then that also then allows you to adjust your capacity for what you could tolerate from a large event standpoint. So you can then compensate and equalize things out by saying, okay, well, now you can write, let's say, 2 coastal Georgia risks. So we are getting pretty intelligent on how we can control that. But that's art. That's kind of the art of all of it. So, that's, so I love doing that. I'm just nerdy that way, I guess. The global warming piece, that's kind of, I think I briefly mentioned, the current weather trends. So, what are the weather trends doing over the last 20 years? And not just looking at it from year to year, but saying, what is this what is years 0 to 5, 6 to 10, 11 to 15, and actually really understanding the trends and the shift, and then applying that to our go-to-market strategy. So that's what we've been using, kind of the weather data and the global warming effect, to kind of normalize that, I guess, in a way.
Okay.
Lisa, could I just add to that?
Yeah.
Just a quick one. So something that we often forget, which I only recently saw when doing a climate change study for a client up in Canada, is that we forget about urban sprawl. So yes, events are changing, but also companies and homes are moving out into areas that they never existed before. And so we get this confluence of events where you have some climate change. A lot of this is expected 20 years into the future, but you do have an element of the climate changing, but you also have the significant drift of where properties are, which is, and so what that leads to is that even if events weren't changing, they're now hitting areas that we didn't have to worry about in the past. So I just wanted to put that in there as something that, we sometimes forget about.
Right. Which is why precision and risk underwriting becomes more important. And yeah, again, this is at location, at portfolio level. And to your point, Darren, like, how do we know that in it? And there's a question coming in on like less reflective modeling and more like real time. We call it like, how do we apply observed data, right? In addition to look back data, right? We've got to, and Kristen opened this all up with, it's the entire cycle of not just point of loss, but preventative underwriting and pricing. We would call it the continuous circle, but how do we create systems and innovation that put all that together? So let's bring it home in our last few minutes. Because I wanted to end on this question specifically. Okay, we talked a lot of innovation. You all have a lot of strategies. You're trying to ensure that we can continue to insure catastrophe risk. But at the end of the day, we have to also make sure that we can handle it on our balance sheet, right? And there's no Eric said it, like, this isn't going to change. What we're doing isn't going to change the cost of nat cat events themselves, right? I used to call it like, how do we change the economic yield curve? When like how do we actually change the cost of repair? How do we change the cost of materials? Because the surge in economics 101 of supply and demand post event is where the prices go up. So if we can't change the event themselves, how do we actually go after the economic yield curve? So that was a technique I was working on with some unnamed, undisclosed companies. And maybe Kristen, over to you. I'd love for each of you to wrap up in about 1 minute or less on how do you all attack, and what's advice would you give to people struggling with this? Like, it's real, right? The cost of nat cat and extreme weather events are real on the balance sheet. Over to you, Kristen.
Understanding what your exposure is key to your protecting your balance sheet, right? But I think in terms of this, I think you're spot on with mitigation, right? If you look at the change in building codes, if we just use Florida, for example, between 1960 and the 2000s, those newer building codes have performed way better in some of these severe storms, right? So as we continue to push mitigation and educate our customers on how they can actually make their properties more able to withstand, that is a big piece of helping to reduce the cost.
Thank you. Over to you, Darren.
Sure. Yeah, I was going to say buy more reinsurance, but that's a joke. So I
we're all waiting for those renewal rates.
Yeah.
I say just make it affordable, Darren. Just make it affordable. We'll all do it.
We had to. You opened that one up.
Yeah. No, I know. I walked into that one. Well, I'm on the solution side, so I have no influence. But yeah, I think working on the solution side of the house, the one thing that I've seen, work well is be very clear in your mind and as a leadership group, what it is that you're targeting. What is your target liability portfolio? What are the principles of underwriting that you want to apply? And Jimmy touched on some of this, and it sounds very disciplined. And have an idea of where you're pushing your rate. And so on those three things, what's my target? What's the North Star that we're going towards? What is the underwriting discipline that we want to have, and where do we want to get our rates to? Having a very clear picture of that in mind and being very disciplined in getting towards that, I think is where we've seen the most success. And what we'll continue to do from a Swiss Re solution standpoint is help in those dimensions and support in those dimensions. But yeah, I'll leave it there.
Awesome. Jimmy, over to you.
Yeah, I think Darren kind of stole my thoughts. So, but yeah, for us, it's gonna be discipline. If we can stay disciplined now, we can continue to build value and offer that to the markets. I unfortunately, I think the E&S carriers are going to be the short-term winners here. But I think there will be change. But until then, we're going to continue to be disciplined. We're going to know our limits. We're going to continue to evolve, the data, how we look at it, and just make the right decisions and add as much value to our insureds as possible.
All right, Eric, wind us down. What's the final thing that we're going to tell people they're sitting in your shoes? What do they need to be thinking about?
Well, honestly, Darren's comments, if I subbed in risk engineering or engineering, wherever he was mentioning modeling, it still applies, right? Focus, discipline, but pragmatism. It's got to be pragmatic. And to be pragmatic, right? Like Kristen said so many times, you have to know the risk. I cannot say it enough. Our industry's role in education around quickly shifting risk on nat cat and climate change is our best place to start. If our clients, if our policyholders, if they don't understand what we're talking about, if we can't speak about these risks at a really basic fundamental level and how it impacts their ability to stay in business, then our industry is doomed, right? So we have to be able to pragmatically discuss it, show them, and give them options around mitigation and adaptation. And those options, they can be small and effective. They can be emergency response based resilience recommendations. They can be business continuity based. And yeah, they can be building betterment, infrastructure betterment. And they can really range the full gamut of CapEx conversations with our risk managers, our CFOs. But it
All
has
right. So I'm going to have to jump
start.
in on the keep it simple, disciplined. Make sure you know your capacity. Make sure you're applying these innovative techniques. Thank you all. Before the time cuts us all off, I wanted to say thank you to our amazing audience for your engagement, for your participation. It is being recorded. So for anybody that wasn't able to listen, you can download and listen to it after the event. And with that, signing off, thank you very much, Kristen, Darren, Eric, and Jimmy, for being here on the Reuters Events and Swiss Re sponsored Catastrophe-Proofing Insurance, leveraging data and analytics for sustainable growth. Look forward to seeing you all in the new year and continuing our mission to fuel the industry forward. Thank you all very much for being with us today.